The good news is that this year investors will continue to favor emerging markets due to strong growth fundamentals, according to bond analysts. They say that there's still demand for Malaysian bonds in 2018, but however, this could change next year due to more monetary policy tightening ahead, including from the US. And the first Fed meeting, which will be chaired by Jerome Powell next week, will give us more insights on what lies ahead.
With a new person in the Fed, I think the rate hike is going to be a little bit more than expected. It's probably about 4 times, you know. And I think the market is slowly pricing it. And the 10-year bond yield for US, that one 3% is just about any time it will breach 3%.
We know the movement of foreign capitals is very fluid, is very sensitive to what happens in the state. So I think we should continue to see some level of volatility in the MGS yields as the economy tries to adjust with this rising interest rate environment.
A volatile financial market. Because if you look at the equity market in US, for instance, like if you look at the famous indicator, Warren Buffett's indicator and so on, you know, market cap to GDP, that's about 150%, something which I think they are quite concerned. Some of the investors are quite concerned. When you reach that level, you have a quite significant correction in terms of equity market. So we have not only volatility, we're going to have not only volatility in the bond market, but also in the equity market. Still, I think it's not going to be a crash in either of the markets this year, because macro itself tends to support the overall picture.
This year, for instance, I'm looking at corporate bond issuance of another 90 to 100 billion gross issuance. So at first glance, it sounds quite sizable numbers, but if you take out the expected maturity, probably net issuance is going to be far lower than that. And you map that relative to the fund size of those institutional investors, then even the corporate bond market is going to be supported.
I think there's going to be some sort of correction. I don't know how sharp it's going to be. I'm not talking about collapse of a bond market, which I think this year is still going to be okay. The only thing which I'm more concerned about is actually maybe a year from now, 2019 or 2020, once the rate hike, more rate hikes actually come in if the economy strengthens further.
Well, 2019 is going to be a bit different than 2018, because let's take from the perspective of Fed funds rate. Let's assume that this year we're going to have that expected 4 rate increases materialize, and if you look at a projection released by the FOMC last time, even the market is looking at another 3-4 come 2019, another 3-4 interest rate increase in 2019. So with that, it will push US interest rate to around 3%, assuming those forecasts given by those officials materialize. So it will further narrow the positive carry that of the ringgit against the dollar that I just shared. Then that may cause, or that may trigger a lot of homework needed to be done by those who are having exposure in our sovereign bond market.